Hello, ladies
Ladies
and
and gentlemen,
gentlemen. We are back for another week of SoFi Weekly. Got a lot to talk about. A lot happened this week. A lot to get into. First, before we get into that stuff, Tanner, Chris, how you doing?
I'm doing very well. Doing very well. I
Same
tried to
here.
get a game of chess going with Chris just right before the live, and he backed out.
It was like 5 minutes. We don't have enough time.
I play nothing but bullet. We would have played like 4 games.
Did you see Magnus Carlsen? Magnus Carlsen went 9 for 9 in Croatia last week.
I mean, that's not surprising, dude. He's the best chess player in the world, man.
It's insane.
Tanner's pretty good too. Tanner's good. He's ranked for what's your ranking? Like 1,000 right now, Tanner?
For what's called 1-1, like a minute plus 1 second intermittent, I'm about 1,200 right now. But which is not like Tevis is, I think 1,400. So he's my competition for sure.
Yeah, nice.
So Riley and Tevis couldn't make it tonight. So we've got Chris in to discuss SoFi with Tanner and I. I guess we'll start off with the breaking news that we have at the top of the hour. Cathie Wood buys 424,000 more shares. Tanner, your raw thoughts?
Dude, exciting. I like when people buy stocks that I hold. It brings up my price. And as simple as that. I don't think she's on to any magic sauce that I don't know about. I don't think that there's due diligence that we're not doing. I just think it's a matter of student loans are coming back. There's some new opportunities for SoFi, and she thinks that now's a good time to buy. I'm not even buying at these prices, but I am holding. So I'm happy Cathie is.
Chris, your thoughts?
I mean, her whole fund is based on innovation, right? I don't see SoFi necessarily being like innovation. They're disrupting, but they're not innovation because all it is just, in my opinion, it's a bank that's completely online, that there's no physical footprint, which is, there's tons of banks that are like that. The thing is, they're, in terms of qualitative practice, they are really good. Like I have SoFi right now. I'm using it actively. I switched over my direct deposit, my wife direct deposit. This week, I actually finally switched over my Roth IRA to SoFi. So what I'm trying to do right now is I told you guys, like, my whole objective with SoFi is to transition my entire banking experience to SoFi and see if there's any meaningful degradation, right? So in terms of cost, it's actually benefiting me because the rates on SoFi savings is like much higher than what I'm getting with TD. Not to mention, I'm not even in New York anymore physically. And there's not really any TD branches here in Atlanta. So it was either join JP Morgan Chase and get no interest, or join SoFi and get a good amount of interest. So I figured this was a good way to, like, one, get more return for my buck anyway, and two, do research on SoFi to see if this is something that's going to be a product that's appealing, not just to the newer, like, younger age population, but someone like me who's in prime earning years, right? Because that's what you're looking for. You want prime earning years. And one of the things that I didn't realize is that you need to have direct deposit in order to get that 4 point something percent rate. You can't just say, okay, I'm going to move some money there. Because I originally was like, oh, I'll just keep my direct deposit where it is. But no, you have to move your direct deposit to SoFi, which is okay. I don't care. It's just
which is that leading you to spend through the app as well? Like, do you have all your bill pays set up there now? Do you have a credit card? What do you have there?
So I just got a credit card. I haven't got the physical credit card yet. They gave me the electronic one, but I'll be straight with you guys. I probably won't use the SoFi credit card much, only because the rewards points on my Amex Platinum are just so much better. So that's just the truth, right? I'm not to mention,
I guessed the card.
Yeah, I was not to mention, like, I'm already paying the amount that I need to for like premium for Amex. So it only makes sense to use my Amex for majority of my spend, right? Now, the thing is, though, like, not everyone is going to get that Amex Platinum because, dude, it's a pretty substantial yearly charge that people are going to have.
$700, right?
Yeah. Plus, I think there might be actually more, but there's a lot of benefits to it too if you utilize it correctly. Like, I travel a lot, so like I use the Amex Centurion lounges, which are just like out of this world, dude. I've definitely made more money back by just going to the lounges than any other product that's there. But you still get like $15 a month in Uber credit. You get like some some benefits with like Saks Fifth Avenue. You get cash back on certain things. They also like you can sign up for different partners that they have and get discounts there. So it's just a really good card to have in terms of like your active spending. But I will say I'm definitely going to be using SoFi for those occasions where my Amex is not accepted, because there's tons of businesses that
Yeah.
they'll just tell you up front, like, please don't use an American Express, like the charging fees, because it charges the businesses a lot compared to like
Yeah.
the clearing costs with Visa and MasterCard. So the SoFi credit card is branded a MasterCard brand, which is accepted by pretty much anyone who uses Visa anyway. So it's good. So, but I don't expect myself to utilize it that much. What I am happy about though is that everything is under one roof. Like that experience is nice. Like to have all my accounts just put into one thing. I'm gonna eventually move my IRA in there as well. My that I have on the side. The only thing that prevents me from moving more accounts onto SoFi is some of my trading I do like on like Fidelity, like the optionality is not there for SoFi.
Yeah.
And I don't think it'll ever really get to that level where it's going to be there, cuz like I do stuff like bonds, right? And I do stuff like preferred equity. So there's a lot less offerings there, but in terms of just if you want to buy a stock and hold it for a long time, SoFi's Invest is good. I haven't got the new UI update yet, so I'm waiting
Yeah.
for that patiently. So hopefully that helps. And yeah, and we'll see where things go. But overall my experience so far is good. I am having some difficulty in transferring all my stuff only because I've had so many so many like bills that are originally part of my TD account that like I have to slowly transition everyone over. So I have to keep some money in my original account. I think that's the biggest drawback to switching banks, because if you've had like 5-10 years worth of history dealing with one banking institution, it's really hard to like switch over. And eventually my goal is when I do buy a home in the next probably year or two, maybe 3, I'm going to be using SoFi's mortgage application to do mortgage with them. So hopefully being a member ends up paying off, because then they'll have my credit history. They'll have me being a member with them loyally, and they'll also have my mortgage business. So
quick little shout out to Chris. He did just open a Patreon. I'm going to put that in the chat. So for those that have been asking for Chris's exclusive feet picks, they are coming up. But Tannor.
Jeez, man.
So
I subbed last night for $10 and they do not disappoint. I promise.
That's a joke, by the way. There's no feet picks.
No, it's not a joke.
Yeah. So that would be your second mortgage with SoFi, right?
Yeah, but I had a mortgage about 5 years ago. But then we refinanced down to like 2 point something with Rocket Mortgage, because dude, it was such a really good deal. So
yeah,
made sense. But yeah, the experience with SoFi, the original mortgage lending process, was very nice. Like it was literally just, we sent in our information. My wife works in the medical field, so they understood like, hey, people in the medical field also have a lot in student loans, but their income makes up for that. So the other banks were probably a little bit more like probably restrictive, whereas if you do it via SoFi, they take all that stuff into account. So overall it's a great product. I enjoy it. I like it. I could definitely see it becoming the primary driver for all my stuff. The only thing is now I have to figure out, like I'm listing my apartment in New York, and my listing agent requires me to post a listing fee. So I'm like, okay, how do I do a check to these guys? That's the question now. So I have to figure that out with SoFi. Like maybe you guys can tell me. Like, so what do I do if I need to like send a check to somebody?
I think you can. I think you have to go into their special like support. It's not readily available. But I wouldn't actually know too well. I'm not even a member. So
like, do they issue a check like a checkbook? Like, do you
I'm
know?
not sure. I'm not sure. What do you guys have for like? Do you guys have bank drafts there or something similar to that in America? Like a certified check from the bank?
I'm sure they did. I'm sure that they do. I just have to look for it and then probably order a checkbook, so that this way, just in case I still have
They
to
have
deal
checkbooks,
with like
people are saying.
yeah.
Yes,
Yeah.
you can get checks.
Yeah. I'll probably just order a checkbook and then I'll send that out. Yeah.
Okay.
That being said, though, what's it called? I spoke with a guy named Ron Shevlin, who is the chief research officer for Cornerstone Advisors, and he recently just did an article for Forbes called um, the "There's a checking account war." I forget the exact title. There's a checking account war, and the fintechs just won. Something like that, where he showed off all the new all the new checking accounts, and which banks were actually signing up the most accounts. And there was a couple things that he had said, like,
Well, before you go, Tanner, that was the easiest process of ordering a checkbook that I've ever had. Like, I'm gonna hide my address, of course, but dude, literally, it took 2 clicks, and I already have a checkbook on its way to me.
Wow.
Like,
there you go.
yeah, I literally just went to the app. I was like, oh, okay. Then went down. It's like order checks. I hit order checks. Boom, the checkbook, and it's like, is this your address? Yes, it is. Done. And I didn't even know there's a joint account.
That was
holder thing,
quicker
too.
than the app itself loading.
That's on your
Yeah.
terrible phone. And we had side by side references with like Riley or something. His loaded instantly. So I no longer have faith in that load time that you showed everyone.
Yeah, it is getting faster. It's getting faster. So
And
find an
I'm
ATM. Yeah.
really surprised you're moving a lot of your investment stuff before the invest update. And then once like level 1 options and stuff comes out, I mean, it just reduces your need to maybe go to Fidelity more often.
Well,
Who knows?
it's stuff that's pretty much just like on autopilot that I'm not like looking at. It's just coming
Yeah.
in. Like there's tons of dividend companies that I have that I was just like, okay, you know what? This account is primarily built for just dividend payments. So as long as it's not something that I'm actively going to be trading. I think that's the difference between something like Robinhood and SoFi, where the experience on the trading side, if you're actively trading in and out of positions, I think Robinhood is a little bit better with the UI and UX experience, which I'm sure the SoFi is going to correct.
A little bit.
But if your portfolio, yeah, it's
I
really
got the
much
SoFi
better.
update, by the way. It's still not good. Like
Really?
it's not, the invest update is
Yeah.
horrible. It's not good. They haven't changed anything, to be, in my opinion. They haven't. I don't know what
You got the update?
I got the update. I updated it 2 days ago. I was just like, what is this? I was like, it's not enough. It's not. And I'm not saying that because I'm biased because I have some shares in Robinhood. Obviously, I have more in SoFi. I want them to win. But
Yeah.
this is a hard thing to do, to make a Silicon Valley product be beautiful. It's not easy.
Yeah, and I mean, and like, so I was talking to Ron Shevlin. This will tie in, which I thought was quite interesting. So he went over all these statistics talking about, fintechs won't be able to compare to the large incumbent banks right now whenever it comes to the client base getting much older. As people get older, they'll need more advanced products. They'll head back to the mega banks. These were some of his points. That the average very affluent client doesn't actually choose fintech. They stay with the mega banks. And there was all these points down the line. And as he was going down the line, going through this article, he had to make an exception every time. Well, SoFi is an exception to this rule. SoFi is an exception to this rule. SoFi is an exception to this rule. Will people go back to the mega banks if they're staying, or if they're currently with SoFi? No, like that one might be the only one where people can actually, continue to stay at that bank instead of having to move elsewhere.
So he's saying richer people are not going to use SoFi, even though it's a better product, because
no.
No.
Both you guys are looking down at your phone. What he's saying is fintechs, people are going to leave Chime because as you get richer and you need more financial products, that you're going to leave Chime to go over to a larger financial institution. But as an exception, SoFi does not fit that rule as being, well, because it does attract affluent clients, because 4.4% is good. You have personal loans, student loans, home loans, all those types of financial products. And by the time that client base actually does get to the age where they'll need them, they're sure that SoFi will also have that selection as well.
I just want to thank William in the chat. Yeah, I just saw that. Now I'm going to just send a physical check. I mean, I'm going to probably end up getting that checkbook anyway, just in case I do need to write a check for whatever reason. So that's good. But yeah, I didn't even know you could send a physical check to a location. So that's simple too. This is what I mean. Like, these are like the things that are like when you get a new banking experience, it takes a minute to get used to it, but everything seems so goddamn convenient. Like right now, like right here, if I want to send the check to a physical address, I could just go to this thing and boom, it's right there. Send a physical check, or I could send it to a company electronically.
Right.
Yeah, this is good. But it's labeled as bill pay, so it's pay. So that just yeah, okay. Gotcha.
Yeah, and that's one of the funniest things. Like whenever I look into a lot of these fintechs lately, is like they know 95% of people are sticking with their traditional banks because of cash. Like PayPal, if you want physical cash, there's ways to pull cash out of your PayPal account. There's ways to pull cash out of your SoFi account. They know that they have to address this issue. It's just a lot of people don't think about those whenever they think about SoFi. They don't think about the physical checkbooks, but obviously they know that that's a big barrier of entry, right?
A couple comments. Johnny, you said Hood raised their yield too. Can you say what? I think it's still 4.65. Did they raise it to 4.7? Let us know.
I haven't seen anything.
I didn't see that. TJ, the wheel deal. Shout out to you, man. He says if SoFi closes below 850 on August 4th, I'll be over 500,000 shares in this company. The position will be officially maxed at that point. That is insane. That's like institution. That's how much Cathie bought today. That's crazy.
So, Chris, now that you're able to, I don't see anything on Robinhood's blog or anything. So I'm not sure. I'm sure you can check the app though. Now that you can send checks and everything like this, like, are you buying the stock back or what's going on now?
To be honest, I might end up selling some cash. Like I'll be straight with you guys. Like I'm tapped out of cash right now. Like I'm invested in the market. I am probably going to be reducing a few positions here and there next week, just so that I have some cash on the side. Because the whole thing right now is like, I feel like the market is so overvalued that regardless whether or not a company is performing well, if there is a sell-off, a general sell-off, then everyone is going to take a hit, right? So I'm not comfortable with the current market the way it is with like companies like Canoe. Canoe was up like 60% today. Fucking Lucid was up 100 something percent over the last like 3 days. So like there is a lot of sentiment around euphoria, and I never like investing when there's euphoria, man. That's the part that always fucking like gets me like my spidey sense starts tingling. And that's probably because I've been in bull markets like this where I've seen nonstop buying of securities by people without any regard for valuation. And then when things correct, it's like a general market sell-off. It's not even like, oh yeah, the shit companies all got sold off. Like, no, everyone gets sold off, you know? So that's the kind of stuff that I'm a little bit like, cautious with. But in terms of like cash, I'm pretty much fully invested in the market right now, which I should probably take some off the top, to be honest with you.
I'm thinking about the same thing. Like I'm sure you just went all in on Nvidia or something, a more safer play. No, I'm just joking. But I'm actually thinking about trimming Nvidia now. It's getting.
How many Nvidia shares do you have?
Well, I've never said.
Can you say it publicly? So, can we get an exclusive? Is it more than 100?
He's got a lot. No, don't do it. Don't do it.
Right now, it's my largest position.
Wait, it's your largest?
Yeah, it was my second largest for a real long time, but at over 420, it's my largest.
So it's obvious to say you have more than 100 shares, something like that.
Stop that, Amit. Stop that. Yeah, don't do that. You don't have to say it. Stop. You don't have to say it, Tanner. Dude, whatever it is, congratulations.
Like I have $700,000 in Nvidia.
Congratulations, Tanner. This is what good investing looks like, because when things get irrational, this is what you have to do. I know the thing with Peter Lynch. Everyone says, "Oh, if a company is good, don't sell your winners." But everything is good. I'm like, bro, Peter Lynch, and things can go way higher than what's normally expected. And sometimes it's good, especially if it's a position that you've held for a very long time, where you don't have to deal with the long-term tax consequences. By all means, trim a little bit off the top, buy some puts on the fucker, and then.
So you think you're better than Peter Lynch?
Hell fucking yeah. Peter Lynch was a bitch and he quit. I did it.
That's the take. All right, hold on. Before we get into that, Jesse, thank you for the $50 super chat. First of all, shout out to this guy. He has been doing phenomenal this market. For those that don't know, Jesse is the most transparent stocks finance guy on the planet. I'm going to put his Twitter in the chat right now. I think he made like $200,000 today or something ridiculous.
I think he's up 400 grand this week.
Yeah, it's like everyone should follow Jesse just to see how he thinks about positions, or not to follow him into every stock, but just to see how someone with that much wealth is thinking about positions. And look, if you're up 400 grand in a week, you must be doing something right.
Bro,
So
he's up 600% for the year. Okay. Let me just put that into perspective for you. Warren Buffett is not up 600% in the last 20 years. Just letting you know. But
Jesse's insane, bro. And he came out of nowhere. I remember in May, he had like 1,000 followers on Twitter, and he kept sending $50 in the Palantir Weekly. I was like, who the fuck is this guy? Next thing I know, he's on Twitter. He has 17,000 followers. He's exploding, and it's because he's being so transparent and he's getting a lot of these plays right. And
I think the key thing that people have to remember when it comes to this is, guys like Warren Buffett, they're like battleships. It's really hard to turn a battleship. So when they make investing decisions, they're making decisions at the $1 billion level, which is good and bad at the same time. Because if you have to buy $1 billion worth of stock in a company or $1 billion worth of options, it's really, you fucking can't do it. You don't have that there's no company in the world that's that liquid for you to be able to move $1 billion in and out in an afternoon. Whereas guys like Jesse and me and you guys, we're not working with $1 billion. We can move in and out of a position rather quickly. We can buy up options.
Liquidity.
Yeah, we can buy up options at a significant discount and premium, and it's nothing that's going to be like, oh my god, if I put in an order, like he would have to put in an order. Let's say if he was buying like at the level that we are, he'd have to put in like 50,000 like call contracts on SoFi to get the same kind of like juiced up return that we have. So we're like these little mini ships that can fucking just go in and out of things versus the battleship, which is Warren Buffett. Now, there's just one caveat to that. Over the long run, Buffett wins. Okay. Jesse, I love you to death. You're totally right on so many things, but even that a 600% return year after year after year is impossible. There are times where once you get to the point where you are holding the aces, it's time to slow down a little bit, take some of that money, put it into some index funds and some dividend payers, and just go off into the sunset and just relax.
I think he even admitted it because
he
said he didn't buy options for like the past couple of years, right? Like this is the first year where he actually started buying options because he finally saw the assets were undervalued. But you can't do that every year. You can't buy options every single year.
Someone said
said
nobody believes Jesse's trades are real or the positions are real. He trades them in real time. You can just track it. You can just look at the positions that he's making whenever he opens them.
Now. Yeah,
and then whenever he sells them.
I don't know if he's the best at Photoshop. I think he's better at trading.
Not even about Photoshop. You could just he tells you when he buys too. He's not just telling you about his sales. He also tells you about his buys. So as things go down, you can just, you know what I mean? It's all in real time.
And the thing is, he came in on the two biggest stocks of the biggest communities, Palantir and SoFi, right when they were about to take off. So he did it so right from like a content perspective, but then he got them right because he got them at Palantir at 11, SoFi at like $6, and he made a fuck ton of money on them. He got all the Bitcoin miners right as well. So it's pretty cool. Thank you, man, for being here and being part of the community.
So I think the biggest thing is you have to know when the timing is right and when things are fucking absolute at their worst and dog shit. The market is just it's gonna keep going lower. It's gonna keep. That's when you have to just close. You have to just put your fingers on your nose and stop breathing for a little bit and just buy and just relax. And then your thesis will play out. Right. The question is, at what point do you start to do that? And that's the difference between a person who's just buying the dip versus a seasoned investor who knows that, hey, there are actually some changes that are coming down the line that could be affecting the market, in which case this is probably a bottom.
So Chris, as a seasoned investor in this bear market, and we still might be in it, but over the past 2 years, do you think you have timed the bottom effectively enough for you to be happy with your returns? Or do you think you could have done an even better job?
Absolutely. I'm up 200%. I mean, 200% on a portfolio my size is good. I'm not like Jesse by any means. Okay. Like Jesse kills it when it comes to more like, cause he's a lot better with the option side. I'm more on like the spread side. Plus I do a lot more like fundamental analysis. So I look for very undervalued companies and then being able to buy them and then just wait out until the options play that I have ends up working the way I want. But I know that after this year, once the correction is completely done and we're back into a normal market again. We're not in a bull market or a bear market. We're in a normal, just cyclical ride up market. I'm not going to be in and out trading positions. I'm just going to be holding on to like dividend paying companies that are going to be pretty much just providing me a nice fixed income that I'm going to use to reinvest in some of the more speculative names that are out there that can give me an outsized return. The goal here for, huh?
Like Nubank?
Yeah,
Or?
Nubank is one of them. Yeah. Me and you, Tanner, we were talking about Nubank when it was $4 because we were like, look at the CEO, look at the growth trajectory this company has. You cannot value it like a traditional bank. If you try, and that's the key mistake that even the Morgan Stanley guys just made with SoFi, saying, "Oh, these guys are a bank." But if you see the trading patterns, like because I have it in my portfolio to on the watch list, they are trading in line with big tech. Where when big tech is up, SoFi is up. When the banks are up, SoFi is like flat or down, which is kind of interesting to see that dynamic. But that's because SoFi is being categorized almost like a growth company right now, where it's kind of a hybrid between growth and tech. You know.
All right, can we go back to your 5-minute spiel on why you think you are better than Peter Lynch?
Yeah.
Absolutely. Because I didn't quit. Peter Lynch is like, oh, I'm stressed out. I'm gonna quit. Bro, I've been investing same amount of years. I didn't fucking quit.
Yeah,
but
look at his hair. Like like this dude is stressed. Like in his 40s, this man was gray. Like,
yeah, but by the way, I'm just kidding. By the way, I think Peter Lynch is amazing. Yeah, Peter Lynch will by far be one of the best investors ever to have ever existed. And a lot of my trading strategies, a lot of my investing strategies are based on the Peter Lynch's teachings. But I have modified some of those things to fit the modern day. Because remember, a lot of the stuff that Peter Lynch has was tailored towards back in the day when things were a lot more just focused on, well, there was a lot less retail participation. That's the key. Right now, there's so much retail participation where things can get a little bit, wacky. Like as an example, you can have further overvaluations nowadays than back in the day, right? Because there are people willing to buy up companies like Nikola. Like, dude, Nikola is technically speaking the perfect short anywhere if you look at it. They literally have no revenue. They're in a business that isn't growing. They had former CEOs and executives who are pretty much frauds, but it's still rising higher, right? So how do you account for that? And the only way I can account for is just saying, look, retail traders are going to be able to really do serious damage. So if you are stupid enough to short this market, you better be goddamn ready, because it's not smart to short any company right now, especially if we're in this zone of we want to kick Wall Street in the nuts. Like if you have enough people that get into that mindset, no company is immune from a short squeeze. So
I have a question. It's kind of unrelated, but it reminds me of it's a question regarding old markets versus these new type of markets. Do you think that a lot of conversation has gone around like market cycles and how long they are historically, bullish and bear markets, these sorts of things? Do you think that these cycles are shortening due to the speed at which people can trade versus whenever Peter Lynch was at Magellan or running the Magellan Fund?
Absolutely. I think human psychology, like the stock market is based more on human psychology today than ever before. Like back in the day, you could look at it and determine if a company's balance sheet is good, if the business is profitable, and then all you had to do was just buy it and invest it, and then you could just chill and not really do anything with it. Nowadays it's a lot more like, hey, you'll see a violent move higher and a violent move down. Like here's an example. Do you think Nvidia right now, you think it's the institutional investors that are riding it higher and higher at this valuation, or is it a lot of retail driven hype around AI that's pushing them to buy, and then some institutions saying, you know what, maybe we'll dip our toes in it a little bit, and then they're joining in on the fun?
I do think it's a lot of institutions. I mean, you don't get to a $1 trillion market cap off retail trading. I don't know. But
I think Chris jumped from like 449 to 450 to 460. Yeah, maybe it is retail, but obviously institutions led to the 200%. But yeah, I mean, the people who are buying it at 450, it went to 473 today. I mean, I would imagine the people buying it at 471. It could not have been institutional investors, right? So
Yeah, just look it up. I gotta look at their institutional ownership over time because I think that'll be the good indicator,
Sure.
right?
Yeah. Yeah.
That's where you need like a good data broker to like give you that information. So
I'm a big fan of tracking institutional holdings. Now, I don't put
Mhm.
really any weight into analyst predictions, but I do put weight into where the money is actually going. You can make a bet all you want on paper, but once that actual money goes over there, I do put a lot of weight on institutional
so
holdings.
without looking at it, what percentage of institutional holdings do you think Nvidia is?
I would say 45.
Yeah,
It's
I
No.
probably
place it.
70. It's probably 70. It's probably 70.
It's close, 65%.
Yeah.
But 65 is actually not that good. Because if you look at most companies that institutions like regularly hold, it's closer to be in the 80s and 90s. You know what I
Mm.
mean? Now
Wait,
the thing is like
what are you talking about? Name a stock that has a 90% institutional holding.
there's tons, like JP Morgan. Look at JP Morgan. JP Morgan, right? Let's do an exercise. Go to what is it? What's a good one? FinViz is pretty good for that.
I don't even believe
Uh,
JP Morgan's gonna. I'm not looking at it just yet, but I have a
By the way,
hard
we have
time.
to talk about their earnings today and what that means for banks. So we'll
Yeah,
talk about
let's do that as well.
yeah.
And we also have to talk about the Noto CNBC interview.
JP Morgan has a 72% institutional holding.
Yeah. Let's see.
Like it's very honestly, you know where you'll find a lot of them is in a lot of the cybersecurity stocks. Weirdly enough, a lot of those
Yeah.
companies have really, really high institutional holdings.
Yeah, like I'm looking at Dexcom right now. Dexcom is 99% institutional holdings.
What percent short?
Short is 3%. Short
Oh,
ratio.
okay, wow. Yeah, and that's huge.
Yeah. So no, EQT, which is a energy company. So here, let me just share my screen with you guys and show you. So for everyone watching, institutional ownership is basically like the big guys. When the big guys own stuff, like it reflects on their institutional positions. So like I'm only going to be looking at large cap, right? Or let's do mega cap because mega cap's
You got to zoom
interesting.
in a little bit more, Chris.
Okay, sorry, it's just really small. So you guys see this? Like Visa,
Mhm.
Visa is 98.9% institutional ownership. Okay, then you have Thermo Fisher, it's 91%. Let me just put it here. Yeah. And then these are all the other ones. Like Google is 78%. Meta is 75% institutional ownership.
Wow.
Yeah. So those are like the things. Like you can also see like insider transactions, like who's buying and who's selling and all the stuff too. But yeah, it's just institutional ownership is a good indicator for like how much like the big guys are really invested in this thing. So
I'm really surprised by that Visa play. So I was just sitting down, like I said, with that Ron Shervin guy, or Shevlin, sorry. And he was talking about this new rule, the Durbin 2.0. It's a Consumer Credit Card Protection Act that they're trying to do this year, where they're not going to allow payments to go exclusively through Visa or MasterCard. And in fact, they'll have to find a second network to go through where the payments can funnel through either one. And so it could massively impact the total payment volumes that are actually going through Visa or MasterCard. And I don't know what the likelihood of this going through is. It's seeming like it's actually going to be quite dangerous if it actually does. I heard the last time they did something similar to this, fraud rates went up like crazy. It didn't actually save consumers any money. It just shifted who was making money. And in fact, the reason why this was put in place is they said that the credit card fees were way too high and that these people were just able to charge as much as they wanted. And they thought that, whenever the Durbin 1.0 amendment actually went in, that they thought, okay, well, merchants will be making all this extra money, so they don't have to get this credit card fees, and it'll just end up lowering costs and being better for consumers. But no, Amazon, Target, Walmart, all these big players just said, sweet, our profits got bumped, and they never gave any of it back. And then they got massive gross margin expansion. So yeah, I just worry about those two specific things if that thing goes in, is MasterCard and Visa.
Yeah.
Yeah, I have nothing to say to that. It's an interesting take, but I have
Yeah, look into it though, because all I'm saying is just if you don't hold the positions, then you're not going to care. But I guarantee you, these institutions are.
Do you have Visa? Do you own it?
No.
Okay. Let's get into go ahead.
No, I was just going to say I like Amex. I hold Amex, but that's it.
Okay, let's do a couple of super chats real quick, then we'll get into JPM earnings. Jesse Dow, again, another $20. He says, no, I'll beat Warren. He's great, but he's on autopilot now, and things are getting scary, but I still put my money on a blow-off top. All right. Well, Jesse, we're here to see you make history on Twitter. We're all following along. It's your world. We're just living in it. So
he puts his money where his mouth is.
Puts his money.
Dude, TJ too. TJ's another one that he knows. TJ has got his wheel strategy down to a fucking science. You know, all the power to him, man, because they're killing it in the market.
TJ's got a question for you. Thank you for the $10, TJ. He says, why not a cash secured put on end phase as opposed to waiting it for potentially to drop to 150, get paid to wait, still deciding whether you want it or all? Just curious.
I don't want to go into margin because that's the thing. Like, I'm tapped out in cash. You know,
so you have 0% cash right now.
Yeah, I have very little. I have no cash, but I'm not margining anything either. Like, sometimes what I'll do is I can use my margin to buy to sell some puts, and if I do get a sign, go and margin for a little bit and then sell some of my other stuff that's more profitable. But I really don't want to go on that route, you know. So I'll just chill right now.
Yeah, you know? Robin had offered me 50 grand yesterday, and I was looking at it and I was like, nope, not doing it. Not responsible enough. I have no idea how to use it. Not doing it.
Margin is one of those things that can really set you back as an investor.
Yeah.
So don't do it. You can take margin on for very, very short period of time just to like complete a trade. But then, you know that you typically want to sell something to cover that margin quickly, because the last thing you want to do is get knocked out of a position thanks to margin, you know?
Yep.
Sure. So Chris, I asked you, I think every single time we're on a call, but you got no cash. What are you buying?
I'm keeping my eye out on things like PayPal is definitely on the top of the list right now.
PayPal's a great call, Tannor. You did well on that one. That's a great call.
PayPal is one, Google's another, Amazon is another. These are like the stalwart companies that will survive any downturn that's coming, and they're still trading below their 52-week highs. Okay, like there's a lot of companies that have started to hit their 52-week highs. Google has not. You know, they're getting there, but they're not there yet. Amazon, same situation, right? Same thing with PayPal is way below their 52-week high, you know, and basically way below their all-time high. But yeah, just like I said, I'm tapped out of cash right now. So this is the frustrating thing. This is the frustrating part about the market. When there's so much opportunity, there's a lack of capital. You know.
Yeah.
So it is what it is. You can't be right all the time. And the position that I'm in right now, I'm pretty happy with their gains. I think there's a lot more further gains to go. Some of my other dividend companies that I have, I'm going to get paid in the next next week. So that money will be nice, because that'll be a nice little fresh injection of cash that I can use to probably buy some options on some companies that I like, but I'll probably wait until I see a mini correction, because I think we're due for a mini correction. I don't know what kind of black swan event that comes that may end up causing that, but I think a mini correction could be coming our way. The thing that I am looking at specifically that I think could give us that mini correction, let me show you guys really quickly, share this with you. You know what? I'm giving so much information. I probably should hold some of this back for like the Patreon people.
Here's the hard part about this. I think they'll appreciate the free content, but I think they're paying for, like, hey, if they DM you, they just want a response. That's what they're really paying for.
Yeah. Let me just show you guys. So one of the things that I always like to use is the Cleveland Fed Nowcast, right? To track inflation. Of course, Trueflation is really good too. But you can see our CPI was down to like 3% for June, which is great.
You got to get used to zooming in much more.
Yeah, sorry.
You can barely see it.
Go here. All right. Can you guys see this
Yeah.
right here? So right now, based on the Cleveland Fed's inflation projection for July, it's close to 3.4 for PCE, which is an acceleration from what they were originally shooting for in June. So there is a reacceleration a little bit in terms of inflation, at least from what they're projecting out. They're projecting for CPI it's going to be 3.3, which in terms of like for anyone, like if you see a 3 and then you see a 3.3, it could spook the market saying, hey, wait a second, inflation is starting to come back again. That means the Fed is going to have to keep rate. Like right now, the market has gone to this zone of, hey, inflation is dead completely, and we're never going to have to worry about it ever again. Like, and we're going to go back to 2%. I am saying, hey, be cautious about that. There could be some market forces that end up pushing CPI a little bit higher in the short term that could end up screwing us, because that means that people will be a little bit more, or at least consumers, not consumers, at least businesses will end up tailoring to a higher interest rate environment a little bit, and the Fed will lose the excuse that they need to probably pause a little bit further, and that might extend them going further. So here's another thing with even in Truflation. I know that it went down to like 2.11%, but there are certain areas where you're starting to see creeping inflation creeping up higher. So this is right here, food, right? Food and energy. It's starting to go up a little bit. Where's energy? This is for transport, which is kind of flatlining at this point. But if you look at like the oil prices right now, which is like a feeder for um, for the other segments, you can see here from this is June. Let me just make this bigger. You can see here. Let me do a 3 month chart. Stupid thing. Okay, whatever. You can see that the June 27th was the absolute low in Brent crude pricing. Well, WTI, which is what we have here in the US. You're starting to see it creep up, and now it's almost $75 a barrel. So if this keeps rising, this is not good. That means that the price of gasoline goes up everywhere. And if the price of gasoline starts going up, the prices of all the stuff that we have starts to go up as well. So just in case anyone was wondering, hey, we've got this good trend going, but be leery and be cautious, because any deviation from going down means that these valuations that we have are going to reverse. And if fortunes reverse the other way, it could be a violent jolt down, So just be on the cautious side. We've benefited tremendously from oil prices declining for the last 12 months, but we may not all be there right now. So like I said, this is just something to keep in mind.
Yeah, I think about that sometimes, like because I'm building out more of a fintech portfolio, and I find that my SoFi and new positions are I find have done quite a run up in this market versus like a PayPal and a Cash App, in my opinion, which I think potentially still have a long runway and just haven't ran yet. And that could be that the market doesn't think that they're worth it. I mean that's a possibility, but honestly, I do think that there will be a change specifically for those stocks. But I have a very hard time rebalancing my portfolio to like I do kind of like that saying, like just letting my winners ride. And it's to be honest, ever since I started doing that, people have called me dumb way more often, but my portfolio has done way better.
Mhm. I would say for me, I always try to be cautiously optimistic whenever I see stuff like this, where I'm not saying I'm bearish. I've never been bearish in my life about anything. What I am is cautiously optimistic, because I don't want to be in a position where I'm so over euphoric about a company or an industry or a sector that I completely let that part of my brain that says, "Hey, take a second look." And then what's good is that there's actually ways that you can actually hedge right now and not pay a fortune. Like, I'm going to share my screen one more time. I'm at 1 second. So can you see my screen real quick? Okay. So you can see here, this is the CNN Fear and Greed Index. You can see that I like this because it gives multiple reasons why, and it uses that as an oscillator to figure out where we are in this. So one of the things that you're seeing right here is this specific indicator, which I like the most, the 5-day average of puts to call ratio. You can see here, everyone and their mother is buying calls right now. Okay, when this goes negative beyond like 80%, that means that the market is super bullish on everything. So right now everyone is buying call options. Prices of the puts are actually pretty cheap depending on which companies you're looking at. So you kind of want to, you know what they say, like you want to be a little bit of a contrarian. So
Sure.
like right now everyone is buying calls, everyone is bidding up call contracts. And it's funny because I'm going to reference Jesse one more time. Even Jesse was a little frustrated today because a lot of the positions that he has, the freaking calls have been bought like crazy, like overbought. So
Yeah.
at this point, it's kind of ridiculous to buy more at that price and pay that kind of premium, especially because you've already written so high that now to eke out an even further gain is going to be much more difficult. So the pricing of the call options on so many companies right now is fucking ridiculous. So, you know.
Yeah, I haven't been following that strategy too much, but I do like how he has to go to such extremes to find things that are still in that sort of, you know, uh value
Undervalued.
opportunity,
Yeah.
like ARC-G, where you're essentially getting a pool of a lot of the things that you already want, but the actual positions for ARC-G are so low right now that he's just betting that it's underperforming.
Let's transition to this clip by Noto talking about the recent downgrade. What do you have to say?
I want to start off the conversation. We have so much to talk about, but start off the conversation on that Morgan Stanley note saying that SoFi should be valued as a bank, not as a tech company or a fintech. What's your response to that analyst downgrade?
My response would be a more diversified financial company that delivers our value proposition via technology. And so analysts can value us any way that they would like, if they want to value us like a technology company or as a bank. If you look at us as a bank, we're a bank that's structuring our business over the long term at steady state to have a 30% ROE. Banks that have a 30% ROE trade at 4 to 5 times tangible book. We're trading below that today. So that's my point of view if you want to value us as banks.
Okay.
Tannor or Chris, anyone thoughts on that? Chris, you're muted.
It's a shot directly at Morgan Stanley.
Why?
Yeah, go ahead, Tanner.
Because that's where they're trading at. He's just saying, hey, if you want to value us at a company that does 30% ROE, then value us like a company that's a 30% ROE. And even funnier than that clip, I found that Chris Hager had brought up this really funny thing that Morgan Stanley back in late 2021 even said if SoFi got their banking license, they would be valued at $34 a share. If they got it by early 2022, then they got it in early 2022, January 21st or something like this. And then now, because they have a bank license and they are a bank, well, they should be $7. And
Well,
markets do change, but
yeah,
that's a big difference.
that's also considering though, Tanner, most of the banks are trading way below book value right now, right? So if you're valuing it like let's say we take a step back and say, you know what, let's value SoFi like a bank. Bro, the banks are right now, they're oversold. They're all literally trading at 60 cents on the dollar for the most part. Most of the regionals are trading way below book.
Yeah.
The majors are trading below book. So that means that yes, it's totally fine to take a price cut on SoFi right now, because I don't see a single bank trading above their normal book value right now, right? Their PEs are all in the single digits. So if you think of it relatively from the other banks, yeah, I agree that makes sense. But the place where Morgan Stanley gets wrong is that they're not technically a bank because they don't have the same traditional banking expenses that the other major banks do, right? They don't have the same capital requirements. They don't have the physical footprints. They don't have the same legacy costs like the other banks do. So those are the things that like Morgan Stanley should probably take into consideration more and value it somewhere in the middle between a high growth tech company with high gross margins, but are being sacrificed on the operational side to grow the business. and the banks, which are on the opposite end of things, where their margins are much lower in terms of gross margins, right? But they're doing well on their cash flow operations perspective. So SoFi should be somewhere in the middle of that, you know.
Yeah, I just wanted to extend that they are talking about tangible book value, not just book value. So you can't count in intangible assets. So that's what he meant by the 3 to 5 times, which I think places SoFi a little bit above a 2x tangible book value or something like that. I think it's 2.2. And he's saying 4 to 5 would be where they should be hanging out right now. But
yeah.
Yeah.
Based on my estimates, fair value for SoFi should be like $15. At the max, should be $15. So in this market, you know, when they're trading at $9, does a 50% premium, 50% discount make sense? Maybe, you know, but like I said, it's all going to depend on right now the market cycle. If the market cycle is poor, they'll end up getting shellacked like everybody else, which means that there's probably some room where you could get better pricing. But I don't think it's there. Like if you're waiting for SoFi to go back down to $4, I think that ship has sailed. I don't think that's going to happen. But I do think that it could retrace maybe to $8. You know, for me right now, the problem is, like I said, I don't have cash. If I had some cash, I'd probably put it to SoFi.
Can someone break down tangible book versus book value?
Intangible assets. Intangible assets are part of book value. Tangible book does not include intangible assets. So like Galileo and Technisys acquisitions are quite hard to value. So there's goodwill as part of that because they overpaid for them. And so that obviously can't go over. Just stuff like that.
Okay, so JP Morgan did 42 billion in revenue, 14 billion in net income, increased 34% year over year. Chris, what are your thoughts on JP Morgan's massive earnings beat and what that means for the rest of banks this year?
I mean, they're benefiting so much on their size. Like, because they're so massive, they don't have to pay shit in interest. Okay. They don't like go to JP Morgan checking right now, see how much they'll give you. Barely anything. So when they lend out money and they have trading volumes, they have side businesses where they're doing other things, that non-interest income plus that net interest income that they already get, they're a perfect money printer at this point, you know, because of the size and security of their bank. Now, where does this fall in line with the rest of the financial institutions? I have no clue. But if there were someone wanting to invest their money in a safe and secure bank that's yielding, I think, a 4% return right now, which is acceptable to most wealthy people, they'll just buy JP Morgan stock and chill with it. You know.
Yeah.
Tannor, any thoughts?
No, I mean, that's essentially it, right? Is that, you know, you can get 4% on JP Morgan. You just have to be a shareholder and not a customer. Like,
yeah,
that's like, whenever people say, why can't JP Morgan compete with the rates of SoFi? I mean, they're just giving it to different people. They're using you as a customer and then giving that to their shareholders. But so, yeah, I don't know. I'm a big fan so far of what I saw on Wells Fargo, JP Morgan, Citigroup. Credit cards did very well. Client assets climbed. Even deposits climbed for all the banks. What's it called? Loans were up like crazy. Also on the other side, so were their provision for credit losses. These sorts of things. So they're defending much higher. Their leverage ratios, meaning like how much money they're keeping on the side just in case things do hit the fan, that's climbing like crazy. So kind of both sides. Now, what I do find interesting is, especially in this high rate environment, these banks are just crushing it on earnings because the net interest income is so high, especially while they're growing a loan portfolio. Yeah. So my question is, will SoFi hit net profitability this quarter, considering loans will be climbing? Hopefully credit cards, you know, all do well. They supposedly are busting it out of the park with new accounts, everything like this. And hopefully customer acquisition cost wasn't too high. I'm sure they're going to keep it at the same pace that it's been on. But that being said, if they sell any of their book, they haven't been selling any parts of their book. If they sell that all in one lump sum, they might break into profitability this quarter for a little bit. But I don't know if the market will actually care. If it's not like, it'll almost be like a Palantir in a way where, you know, a sale of certain assets causes them to go, gap profitable, people might not care as much.
I don't think it happens this quarter. I think they're still 5 cents away. I think maybe we get to -1 cent, but Q3 definitely will likely be there.
Yeah,
I also think it's a little early. I think it'll be nice to see them take their time. In Q3, I think with maybe inflation below 3%, then they're gap profitable. Then we might actually end the year at that $15 price target we want to be at, but probably not right now.
I'm not predicting they will be gap profitable. I'm just thinking about it more and more, considering how much these banks are beating expectations.
Yeah.
Yeah, I think the entire banking sector has been oversold. That's why I have such a large position in Truist, because the risks to the banking sector have all but pretty much been diminished. There's a thing that happened post March lows that a lot of people really don't know about, and that is InterFi. Do you guys know InterFi is?
No.
Okay. The InterFi. Okay, so let me pull up InterFi so I can show you guys. And this is the thing that that's very important to the general market. And the question that you have to ask yourself, because SoFi is actually a member bank with InterFi, how do you provide higher FDIC insurance, right, than what FDIC allows?
You go to
Partner.
other banks and you split all the deposits into 250,000 at multiple partner banks.
Right. Now, the thing is, though, how do you do that? Like, what is the mechanism by which that happens? And that is actually done via InterFi, because InterFi owns the network that does
Cool.
that for you, right? InterFi is actually owned by Blackstone. I don't know if you guys know that.
Is
But
that
yeah.
true though for SoFi? Because I think SoFi does that through Apex, if I'm not.
I have to see which one to do, but I know that Robinhood definitely uses InterFi, because that's how
Okay.
everyone is able to now all of a sudden juice up their $250,000 FDIC insurance to now over $2 million, because they can separate it out and split it into member banks. Now, here's the thing. What other banks are SoFi working with to put their money into to give you that FDIC coverage?
I know it's Wells Fargo is one of them. There's a list of them of all their sweep partners as well.
So this may actually shock you a little bit. Hold on one second. Partner banks. Let me just pull it up. Okay. Share.
SoFi has posted the list though. I know that.
Yeah. This one is for Robinhood, by the way.
Okay.
Okay. So in Robinhood's InterFi network, Goldman Sachs, which is good, HSBC, big, Wells Fargo, good, Citibank, big. I'm gonna leave this one out for a second. U.S. Bank, Truist, MNTB, and First Horizon. Okay, these are regional banks. So now there's deposits sitting on regional banks that now will pretty much take the whole guesswork out of getting a bank run done on them out of the picture, because now they have all this depositor cash sitting there that they don't have to worry about. What surprised me the most is Bank of Baroda is like a small, well, I don't want to call it small, but it's a bank in India. And then the Bank of India is financing some of this interchange accounts, these FDI. I didn't even know the Bank of India was FDIC insured, but apparently it is.
Wow.
Isn't that kind of like
so basically you're saying when Robinhood says you're $2 million FDIC secured, or same with SoFi, they use these other banks to be able to make sure that if something happens, the capital is there for people to be okay?
Yeah. So now, like I said, now the issue around liquidity is completely dead. Like, there are so many regional banks right now, they've got liquidity infusions, that the whole thing with, oh, there's going to be a bank run at this bank and they're all going to lose deposit. No, that's fine. They're good. They don't have to worry about it, because they've got depositor cash from other banks sitting on their balance sheets, waiting to be able to pretty much liquefy anyone that needs the money. So the biggest risk to regional banks is pretty much gone. Now, of course, they have the risk because the interest rates are high, so their net interest income may end up taking a short-term hit. But if you look at companies like Truist and PNC and US Bank, they make a significant amount of money on their non-interest income, which is like transactional income, especially small businesses who rely on them primarily to do transacting. They're going to be just fine. So that's what my bullish case on TFC is for a long time. So So some of the jokes are probably like, "Thank God my money is safe in the Bank of India."
All right, last words, and then we got to be out for Pounter Weekly. Go ahead.
Okay, so okay, well then, okay, if we're doing that, then if we're just doing last words, I'd love some because Chris is not going to probably be on here next week. I mean, you're always welcome, but we only see you every now and then. Any predictions for SoFi coming into next earnings now that you've started to see some bank earnings?
I think they'll do okay. I really just wish I had more cash right now to buy some SoFi, but I probably wouldn't go the options route. I'd probably just buy the stock because I don't see such a large and not to mention everyone and their mother's been buying up the goddamn SoFi calls. So the price of those calls are just rather expensive for me considering the amount of risk that I'm taking on. So if anything, I would just buy the stock over for a long-term hold, I know that I know someone's gonna joke like Chris's long-term hold is 10 days. Yeah, that is 10 days because if the shit runs up like fucking 100% in like 2 weeks, I'd be stupid not to take some of the money off the table and chill a little bit, So just saying,
Yeah.
Okay.
Thanks, guys. I really do appreciate this. It's a much more chill podcast with 3 people on, so it was a little bit more intimate.
Because we didn't have fucking Tevis laughing every 2 seconds when someone says a fucking joke.
That guy's out of his freaking mind.
Wait, you guys think Tevis is the problem?
No, I'm just.
Of course,
I'm
Tevis is the problem.
He's super introverted and quiet.
When he watches this at the end, it's his fault.
Here's the thing that maybe you guys can explain to me. Why does everyone hate Riley?
I don't know. Everyone hates Riley.
I don't understand why everyone hates Riley. Like, what does Riley ever fucking do to anyone? He just Riley just is there, and he doesn't offend anybody. He doesn't go after anybody. But it's like, yo, fuck Riley. Why? I mean, I'm not you guys. I'm saying the comment section. Like, I've been on the SoFi Weekly just like watching, and then all of a sudden, yeah, fuck Riley. Nah, fuck Riley. Riley's a piece of shit. And I'm just like, what the fuck is going on? Like, who initiated this dog pile on Riley all of a sudden?
I don't know. I like Riley.
I love Riley.
Yeah, I like Riley.
This whole podcast was Riley's idea. So
yeah. Seriously, he's the one that put it all together.
I like Riley because he retweets me a lot. And now that Twitter's paying, I'm like, come on, Riley, retweet me, baby. Let's go. Let's go.
All right, guys. Thank you for joining.
When he doesn't.
Please subscribe to Tannor. Please subscribe to mine, whoever channel you are. Everyone's links are in the description for the Twitters. And we'll see you next week for SoFi earnings predictions.
Peace out, guys.
Later.
Thank you.
Bye, everyone.